If you are over 50, living in Florida, or even thinking about moving here in the near future, this video may quietly protect you from making one of the most expensive mistakes of your life. Not because Florida is collapsing, not because the dream is over, but because the rules have changed and many people don't realize it yet. Across the state, rental markets that once felt untouchable are slipping out of control. Cities that retirees trusted for stability, places investors believed would always deliver steady income, neighborhoods that symbolize security are now dealing with empty units, falling rents, and rising ownership costs all at the same time. This is not speculation. This is not fear-mongering. This is already happening in the middle of 2025. Insurance costs are exploding. New apartments are flooding the market. Migration is slowing, and thousands of landlords are quietly bleeding money every month, hoping the market turns before their savings disappear. If you live on fixed income, depend on predictable housing costs, or plan to relocate for retirement, the next cities matter more than you think. Some are becoming traps, not opportunities. Today, we're breaking down 10 Florida cities where the rental balance has shifted sharply. We'll look at what went wrong, what the numbers are really saying, and why these places now demand caution instead of confidence. Let's begin. Number 10. Orlando. For years, Orlando was considered untouchable. Theme parks, tourism, constant demand. It seemed impossible for this city to ever struggle with rentals, but in 2025, Orlando is showing what happens when too much optimism collides with reality. The biggest issue here is not demand disappearing, it's supply overwhelming everything else. During the short-term rental boom, thousands of investors rushed into Orlando believing tourism would guarantee profits forever. Entire neighborhoods were converted into vacation rentals. When travel normalized and competition exploded, that strategy collapsed almost overnight. Now, many of those short-term units are being dumped into the long-term rental market. The result? An oversupply Orlando has never experienced before. By mid-2025, average rents had fallen sharply compared to the previous year. Luxury units were hit hardest, with some seeing declines approaching 20% from peak pricing. New apartment complexes that once leased instantly are now sitting vacant for months. Vacancy rates have nearly doubled compared to pre-boom levels. Landlords are responding with desperation. Free months of rent, waived deposits, covered utilities, parking incentives. In some buildings, leasing offices feel more like marketing centers than rental operations. Small landlords are in the most danger. Competing against large corporate complexes with deep pockets is nearly impossible. Many owners are now cutting rents below their break-even point just to stop prolonged vacancies. For retirees considering Orlando, this matters. Falling rents sound good until you realize instability often follows. Services change, neighborhoods shift, owners cut maintenance. What once felt reliable can quietly deteriorate. Orlando is no longer a guaranteed win. It's a cautionary example of what happens when one industry dominates housing decisions. Number 9. Cape Coral. Cape Coral used to represent the Florida retirement dream. Quiet streets, waterfront homes, affordable living with predictable costs. That image is fading fast. The problem here is not one single factor, it's a pileup of mistakes from the last few years. During the migration surge, Cape Coral experienced a construction and investor frenzy. Homes were purchased rapidly. Short-term rentals multiplied, long-term rentals followed. Everyone assumed demand would never slow. But by 2025, the market snapped. Inventory exploded, demand cooled, and rents began sliding. Three-bedroom homes that once leased instantly now sit vacant for weeks or even months. Many are priced well below their previous highs and still struggle to attract tenants. At the same time, ownership costs are rising aggressively. Insurance has become a financial shock. After major storms, premiums in coastal areas doubled or worse. Some owners can no longer even find coverage. Mortgage rates locked in during the peak are now suffocating cash flow. Short-term rentals have collapsed the fastest. Occupancy rates are far below expectations. Nightly prices dropped, and maintenance costs remained high. Many owners are selling at losses simply to escape the pressure. For retirees, Cape Coral's biggest danger is unpredictability. Rising insurance, declining property values, and rental instability create stress, not peace. What once looked affordable now carries hidden risks that didn't exist just a few years ago. Number 8. Fort Myers. Fort Myers is experiencing a quieter crisis, which often makes it more dangerous. This city didn't collapse suddenly. It expanded too fast. Between 2021 and 2023, construction surged. New apartment complexes rose everywhere. Population growth justified the optimism, at least at first. Then, growth slowed. By 2025, listings for rentals increased sharply within months. Entire new developments opened with half their units empty. The supply pipeline didn't stop even as demand softened. Rents are falling, but not dramatically enough to solve the problem. The real damage comes from extended vacancies. A unit sitting empty for 60 or 90 days costs far more than a modest rent cut, but many landlords refuse to accept that reality. They cling to old prices, while losses quietly accumulate. Add rising insurance costs, higher maintenance expenses, and interest rates above 7%, and many investors are now operating at negative cash flow even with tenants. Fort Myers teaches an important lesson. Growth without restraint is not stability. For retirees, a market like this can shift rapidly. Services, demographics, and housing quality can change faster than expected. Number 7. Tampa. Tampa once symbolized balance, strong job growth, moderate costs, consistent demand. That balance is now under pressure. While Tampa hasn't collapsed, the direction has changed. Rents are down compared to their peak. Vacancy rates are climbing steadily. Incentives that once felt unthinkable here are now routine. The biggest issue is migration. Population inflows slowed dramatically over the past year. Rising insurance costs, higher living expenses, and limited wage growth have pushed some residents elsewhere. When population growth weakens, rental demand follows. Landlords are adjusting by offering concessions, but that cuts profitability. For leveraged investors, margins are disappearing. For retirees, Tampa remains more stable than many cities on this list, but it's no longer the safe bet it once was. The warning signs are early, not catastrophic, which is exactly why they matter. Number 6. Sarasota. Sarasota shocked nearly everyone. A beach city known for stability and retirees suddenly recorded some of the steepest rent declines in the country. What went wrong? Oversupply collided with fragile demand. During the boom years, Sarasota attracted developers, investors, and short-term rental operators. Projects launched everywhere. At the same time, many retirees quietly left as costs rose too high. By 2025, thousands of new units hit the market, just as demand weakened. Vacancy rates surged to levels not seen in decades. Rents dropped sharply from their highs. Some data showed dramatic declines, while conservative sources still confirmed a meaningful downturn. The demographic reality matters here. Sarasota depends heavily on retirees living on fixed incomes. When costs rise too fast, they leave. When they leave, demand disappears faster than developers can react. For anyone considering Sarasota today, falling rents are not automatically good news. They often signal deeper imbalance, one that takes years to correct. Number 5. Naples. For decades, Naples was considered untouchable. Luxury, wealth, stability. People believed this market lived by different rules. When other cities struggled, Naples held firm. When volatility hit, Naples resisted. But 2025 is exposing something most people didn't expect. Even wealth has limits. The first crack appeared quietly. High-end rentals began sitting vacant longer than usual. Not empty forever, just long enough to force uncomfortable decisions. Owners started reducing rent slightly, something that almost never happened here before. A few percentage points may not sound dramatic, but in a luxury market, it's a loud alarm. What's driving this shift is not lack of money. It's caution. Affluent renters are traveling less, staying shorter periods, and negotiating harder. Short-term luxury rentals are especially affected. Properties once booked months in advance now wait for guests who never arrive. At the same time, ownership costs are exploding. Insurance along the coast has become one of the biggest threats. Premiums have doubled in some cases. Coverage exclusions are growing. Deductibles are rising. For leveraged investors, these changes alone can destroy profitability. Add rising HOA fees, higher property taxes, maintenance costs, and interest payments above 7%, and many owners are discovering something uncomfortable. Owning luxury property no longer guarantees peace of mind. Some investors are exiting quietly. Condos and villas purchased during the peak are being listed below prior highs. These aren't distressed sellers yet, but they are motivated. And motivation spreads. For retirees considering Naples, the risk isn't collapse, it's rigidity. When a market depends heavily on wealth and seasonal demand, even small shifts can ripple fast. Naples isn't broken, but it's no longer insulated. Number 4. Jacksonville. At first glance, Jacksonville seems safe. Diversified economy, less reliance on tourism, lower costs compared to South Florida. And that's exactly why many investors poured in during the last boom. Home prices surged. Rental expectations followed. Cash flow projections assumed rent growth would continue steadily. That assumption is now under pressure. Rents in Jacksonville haven't fallen dramatically, but they've stalled. And when interest rates rise, stalled rents are dangerous. Many investors finance properties at peak prices using variable or high-rate loans. Today, those payments haven't dropped, but income hasn't grown either. Every month becomes a quiet loss. New construction is another issue. Thousands of apartments have been delivered on the city's outskirts. These newer units attract tenants with amenities and incentives, forcing older properties to compete. That competition drives prices down without any dramatic headline collapse. For retirees, Jacksonville still looks appealing, but caution is necessary. A market can feel stable while still squeezing owners and reshaping neighborhoods. Stability without growth is not the same as safety. Jacksonville hasn't fallen, but it's balancing on thinner margins than most people realize. Number 3. Hollywood. Hollywood exists in the shadow of giants. Not as glamorous as Miami, not as established as Fort Lauderdale. For years, it benefited from proximity. Now, that same proximity is hurting it. When rents began falling in nearby cities, Hollywood had no defense. Renters compared prices and simply chose cheaper options with similar access. Location stopped being an advantage. By 2025, rents had fallen sharply year over year. Vacancy periods extended. Incentives became normal. The ownership structure here makes the situation worse. Most rental properties are owned by small landlords, not corporations. Small landlords don't have deep reserves. When rents drop and costs rise, they feel it immediately. Many owners are now listing properties for sale, not because they want to, but because they can't sustain losses. Hollywood also lacks a strong economic identity. It's not a job hub. It's not a tourism magnet. When regional pressure hits, cities like this feel it first and recover last. For retirees, Hollywood's vulnerability lies in dependence. When surrounding markets weaken, Hollywood follows often faster and deeper. Number 2. Miami. Miami didn't just cool down, it cracked. Once considered unstoppable, Miami became the symbol of excess, and excess always carries consequences. By 2025, rents declined noticeably year over year. While still high compared to national averages, they were no longer enough to cover skyrocketing costs. Vacancy rates rose as thousands of new units flooded the market. Incentives became extreme. Free months, gift cards, parking, anything to attract tenants. Meanwhile, ownership costs exploded. Insurance alone can exceed $15,000 per year in some buildings. New structural regulations after past tragedies forced massive repair assessments. Some condo associations demanded millions in collective funding, doubling monthly fees overnight. Short-term rentals collapsed faster than expected. Tourism softened. Competition exploded. Occupancy rates fell into uncomfortable territory. Many hosts converted units to long-term rentals or sold at losses, increasing supply even further. Miami's problem is layered. Overbuilding, regulatory pressure, insurance chaos, tourism volatility. For retirees, Miami is no longer predictable. The city rewards timing, not loyalty. Stability here now comes at a premium few can afford. Number 1. Boca Raton. Boca Raton represents the final warning. This city thrived during the remote work era. Finance professionals relocated. Luxury towers filled rapidly. Rents surged beyond logic. Then reality returned. As companies demanded office returns and costs rose, migration slowed. High-end renters vanished faster than expected. Entire floors of luxury buildings sat empty. Developers responded with incentives that would have been unthinkable just years earlier. Free months, utilities included, aggressive promotions, yet vacancies remained. Luxury markets break differently. They don't crash loudly. They bleed quietly. Investors who bought at peak prices with leverage are now trapped between falling income and rising expenses. Insurance, taxes, HOA fees, and interest rates create monthly losses that savings cannot sustain forever. Some are selling, others are waiting. But pressure builds either way. Boca Raton proves that even the most polished markets can become fragile when affordability disappears. Florida is not collapsing, but it is correcting unevenly, quietly, and painfully. Cities that once symbolized safety are now dealing with oversupply, rising costs, and shifting demand. Renters are gaining leverage. Investors are losing confidence. Retirees face decisions that require more research than ever before. Cheap does not always mean opportunity. Falling rents do not always mean relief. The real danger lies in misunderstanding why prices are dropping. Before moving, investing, or committing long-term, ask harder questions. How much new supply is coming? What are real ownership costs? Who is leaving and why? One wrong assumption today can cost years of financial recovery. This breakdown was created to help you see what headlines miss and numbers alone can't explain. If you value calm, honest analysis without hype, you're exactly where you need to be. This is Untold Blueprint, where trends are explained before they become regrets. Tell me in the comments, which city surprised you the most? And where are you feeling these changes right now? I read every comment. Stay aware, stay patient, and never follow the crowd without understanding the blueprint behind it.